So what I'm going to talk about today is the exchange rate and the mining boom. So let me go on to the real topics. So as we know, we're in for a whopping big mining boom. And the question is, how does that force the exchange rate up? And what I'm going to argue is that it's not a simple relationship. So if you look at a lot of past Australian studies that try and explain the exchange rate, then they have the terms of trade. And there's a kind of a nice one-to-one relationship. When the terms of trade goes up, the exchange rate goes up. Terms of trade goes down, the exchange rate goes down. Well, I'm going to argue that in fact that usually doesn't happen. It's much more complicated. And so if we break a mining boom up into the source of the boom, so is it caused by a growth in world demand? And if we look at the current boom, that's China and India deciding that they want to be moved from the bush to the city, spend a lot of money on steel and electricity. Or is it due to a discovery of a new resource? And again, if you look at the Australian story, there's a lot of gas projects. So Gorgon and so on is actually a supply shift. And to a certain extent, the fracking and horizontal drilling and so on has made gas suddenly become a brand new resource. Now that's partly for Queensland and New South Wales, but also it's a big issue in other parts of the world. So depending on what sort of the boom it is. Again, what I want to argue is a mining boom doesn't happen instantaneously. And so most of the comparative static analyses that were done by Max Corden and Neary and all those guys we didn't have a mining boom, now we have a mining boom. The reality is they take a long time to take effect. The boost in demand for China, you can go back to the early part of this century. It took about 3 years to wake up that, hey, this is a boom. It then took a couple more years to get approvals to set in place investment projects, to get the money and so on. And the investment is really only just starting to pick up. It's gone from about 2% of GDP to about 4%, and if we believe Wayne Swan, and I don't think we should, then it's going to be 9 or 10% this year or the next year. So there's nearly a decade lag before we got the extra production. And then the production strings on for decades after that. So I think that's going to be important. Again, important issues are who is going to fund that investment? Is it domestic saving or is it foreign saving? And you can actually do, and I will show you some extreme examples in which if it's all foreign saving, not much happens. Again, the investment, can that be mainly made by Australians? Australian manufacturers, Australian labour, or is it fully imported? Now it turns out in iron ore and coal, about 60-70% of it is Australian sourced. But when it comes to the gas projects, it's more like 80% is foreign sourced. And that will make a different story. And then of course there's a real income gain. So the only reason you and I are drinking beers happily, and some of you are upmarket having wine, over this decade is because the mining boom's given us a big increase in income. In terms of productivity, we have done nothing this century. It's all because of the mining boom. And so the question is, how do we spend it? Do we spend it on traded goods, or do we save it, or do we spend it on non-traded? That again will affect the results. So this really should be studied as a big general equilibrium model. But I found that too hard. So I'm going to use a kind of a partial equilibrium model that's really based on the simple balance of payments. And I see this as a building block for a comprehensive GE model down the track. But what I see this as doing is making us think about how do we set up that general equilibrium model? What do I tell Peter Dixon and Chris Murphy and Treasury about what I want in this model. And how might I start to interpret the results? So I see that as a building block. And my key finding is that there's no simple relationship between the terms of trade and the exchange rate. So that's what I'm going to try and do. So what's my model look like? So this is the simple balance of payment identity that links the current account. So that's exports less imports and less repayments of foreign income. That's the current account. And that's roughly balanced by net capital inflow. And net capital inflow, of course, is roughly balanced by the difference between Australian investment and Australian saving. And if we think about the story historically, we have been a net borrower of 2 to 8% of our GDP ever since Governor Phillip arrived. The Indigenous Australians were the last ones who ran balanced budgets. So we've always been a good investor. But the story is it flicks around between 2 and 8%. That's where the action is. And so what I'm going to argue is if you get an increase in the current account surplus, that's a mining boom, more exports of iron ore and coal and a higher price, no change in imports, we've got a current account surplus, bigger demand for Australian dollars, the dollar rate is going to go up. On the other hand, if you have an increase in net capital inflow, Australia looks like a fabulous place to invest in. Foreigners want to start buying our assets. Again, they start wanting to buy Australian dollars. Up goes the dollar rate. Or, if we have a fall in domestic saving, our governments just save as they wonderfully do. Or you and I decide to go on a spending binge as we did in the 1990s. We have to make that up by foreign capital pouring in. Or the other side is, if we have an investment boom that we can't finance with our own savings, we have to borrow foreign stuff. So what I'm going to do is run a mining boom through this identity. And to give it a bit of substance, I've spelled it out on this equation, and I've broken the balance of payments up into what I call mining, which has got the subscript M, and other, which has the subscript 0. So if we look at the first part here, mining exports is quantity of mining times the price of mining, so it's mining exports. XO is other exports, agriculture, tourism, education, that really great export industry that operates under incredibly low productivity because we have the most screwed up Commonwealth state financial relations you can think of. Less other imports, the non-mining ones, and NYT is net income transfers. So that's paying back some of our income on past loans. So that's the current account. And then on the net domestic saving, I've broken that up into SP, which is private saving by business and households, government saving, and once upon a time we had governments that saved. We may get them in the future. Now that Ted's gone, anything could happen. Mining investment and IO other investment. And so what I'm going to do in this model is sort of argue that a mining boom in the first round affects QM mining quantity, PM the mining price, MM mining imports, IM mining investment, and NYT net income transfers. Those are going to be my first round effects. But there's also going to be some income effects. And I'm going to call those as second round effects as they affect other exports, other imports, the savings levels, and other levels of investment. So what I'm going to do is crunch through how a mining boom affects those various terms. So that's the basic model. Now ideally you want to embed that in a big CGE model. What I'm not tracking here is all the detail of different industry linkages. I'm not forcing in all the macro accounting income and balance of payments, employment identities, and so on, that you'd really want to do. Okay, so breaking the industry up, the story about types of booms and stages. I've split the world up into a global demand boom, so this is really the China, India, developing country stuff, which is really a shift in the aggregate demand for mining products globally. So that's going to be initially have a demand increase stage, so I would say that's sort of 2003 to about 2005. And then about 2005 we woke up, hey, China's here for the future with lots of steel, iron ore and electricity. Investments that looked pretty crook in the 1990s when prices were rat shit are actually going to be good down the track. So let's start about getting some investment going. And that's only now just starting to hit the tracks. So if we look at Productivity Commission and other studies, we maybe have 3 or 10 years of this investment phase. And then we'll end up getting the extra production. And arguably, in the Australian case, that's going to last for some decades. I don't think anybody sees the China boom turning over for decades. There's still lots of people who want to get off the farms into the cities. India is moving. Indonesia is moving. Latin America is moving. Sub-Sahara Africa may be moving. There's lots of this stuff on the demand side to come for decades. According to Geoscience Australia, we have proven reserves of 50 to 80 years for iron ore, coal, bauxite and so on. We're a bit short on oil and gold, but we get lots of gas. The only question really is, will we become so damned uncompetitive that we start closing mines? That's the only risk. Or we can have a domestic local supply increase. And this is the ones I would describe, the gas and the coal seam gas and so on. Now I'm stretching luck a little bit to say that that's local because some of that is global. The reality is that Australia has a bit of everything. And what I want to do is work through for each of those types of mining booms, for each of those stages, what that's going to have on the exchange rate. So that's what I do